how's it going, guys? Welcome back to the Capital Mindset Show. Today we have a special episode talking about my largest holding by far in the core positions of my portfolio. Now, that might actually be subject to change, and I'll explain that. But for the title of this video, you guys know what it is. It's Alphabet. All right, so Alphabet really needs no introduction. You're actually watching this video on something owned by the company. So, you're talking to the money here. So on that note, guys, I own less than 1% of the business. So I'm going to go take you guys to the Google search engine, and I'm going to completely shill out my business, right? This is my business, guys. So let's take a look at the performance of my business. And I have to stop. All right. I deserve my humor. All right. So max performance over the course since IPO has been about 5,000%. So market beating returns, fantastic had you invested in Google back then. All right. I got into Google originally around 2014, 2015. So that's around where I got in. We'll explore that price right here. So, because I don't even remember what price it was when I first started, and I'll tell you my average cost basis. Yeah, that seems actually about right, because my average cost basis is about $815, right? So I bought huge back then, and then I kind of nibbled across the way. And when I say nibble, it's nibbling. I nibbled it. All right, and we see actually some recent price action of today, and you see the spike up after hours. Well, that's because they're doing a 20-for-1 stock split. And so for every share of Google I own, GOGL, by the way, that's the one I own, and that's why we're looking up this one. I'm going to receive 20 new shares, okay, as a special dividend should the vote go through. I'm going to vote yes, because, that increases the value, bro. So that has to do with the, belief that back in the, I guess last year, a lot of people believed that a stock split made it cheaper, right? And a lot of new investors, when I speak to them, they think that, sometimes they think like a stock's expensive because they look and say, oh, it's $2,700. That's very expensive, or $3,000 now. But no, it has to do with the cash flows. I know you guys know that, but you might have to explain that to other people when they're first getting started, and then there you go. You just have to tell them that. But for the most part, we can talk a little bit about Google's future prospects. This is a business that's a spawner. That comes from Monish Pabrai's talk. And I know you guys know that I have professional disagreements with Monish Pabrai, and I'll discuss that more in the Alibaba video and probably the Tencent video as well. But I agree with him on some things, and I agree with him on a lot of things, by the way. I don't want you guys to think I disagree with him on everything, but I agree for him, for example, that Google is a spawner, right? And then so even back then, when I first started buying Google, I realized this thing's a spawner, right? At that point, they already owned Android, so I was like, oh, they own that. They already owned YouTube. They already had the largest search platform in the entire world, and so they were experimenting with a bunch of other things. For those of you who remember Google Glasses and all that stuff, Stadia, which is the more recent one, but they had their own experiments, and then they're making so much cash that they can fail, and it doesn't really matter. So we'll get to the model as whether or not it's a buy now, and I'll kind of where I'm going with that. But is it a hold though? That's a different story, and that's something I have to answer for myself. And I'll be exploring this because I actually haven't done this analysis in a little bit for Google, and it's about time I do another analysis on Google to kind of refresh what am I doing? Should I get out? Should I not get out? And then I'll kind of talk with you guys with that raw. And then if you guys have any questions at all, feel free to comment down below, and I'll try to answer them as quickly as possible in a timely manner. All right. So on that note, let's actually discuss a little bit about why I own GOGL and not GOG, right? So because there was a question in the Facebook video regarding, classes of stock, why do those exist? Well, for the most part, I'll give this explanation. I'll try to be brief with it and to the point. But GOG was created to give employees stock-based compensation. And what better way to do that without giving up control of the business than giving them non-voting shares, right? So in a VIE, which we discussed plenty of times on this channel, is a complicated umbrella term for a structure that has all these curveballs and stuff and all these little entities that all interact with one another. Google's not that. When they have separate shares, it's not a VIE. All this is you own the same business, and the business has it split up into different types of shares, some with voting, some with not voting, but all of them have equal economic interest. Keyword economic interest, which means if we have $10, there's 10 shares. It doesn't matter what class share you have, each one gets $1. Okay, so there's no difference in economic interest. But with voting rights, there can be differences, and that has to do with control of the business. Deciding what happens in the business, electing officers, etc. So I prefer to have the ones that were elected. And so for those of you who have been paying attention to Google long enough, know a little bit of a detail that back in the olden days, right, not too long ago, like several years ago at least. GOOGL was actually trading at a premium to GOOG, right? And I think that's no longer the case. Let's actually see, because for a long time now, in the modern time, it's been actually trading at a discount. All right, so that's Google. Oh, it's still giving me. Oh, because I'm silly. I'm silly, guys. I'm sorry. All right, so 2757. Yeah, 2752. So it's still happening. And back in the olden days, again, if you were buying Google back then, you would have remembered that GOOGL was the one with the premium because it had the voting rights. But the reason why GOOG now trades at a premium is because that's the focal point of their buyback. So when Google does buybacks, it's actually buying GOG, not GOGL. So that's a little bit. All right, so now let's actually go to the model here, and then we'll go to the summary report real quick. So you can kind of see here that the model is actually telling me, hey, there's two classes of stock. You got to make sure that you account for that. And there's a couple ways you could do the advanced math way by discounting it a couple over here, or doing something over there. But for the most part, we're going to be changing up the cash flows instead. And then over here, the analysts are saying it's a strong buy. So there you go. There's your recommendation from them. And the price target theirs is a little bit misleading. Okay. So again, for those of you who remember back in the olden days, we're referencing, we are talking about GOGL that now trades at a cheaper discount, a slight discount. All right. So let's actually go to the key ratios and talk about this. So this liquidity ratio is fantastic. Chef's kiss. The solvency ratios also amazing. It's right here at the profitability ratios where I'll actually stop here and talk a little bit about this. And I'll specifically point out the net profit margins. So the net profit margins have been increasing, but for those of you who've been paying attention to Google for a long time, remember these days back in 2017 when the net profit margins were actually really low. We've discussed this many times on the channel, the discrepancies between GAAP net income and cash flows. And if you looked at cash flows, it would have told you a different story and you wouldn't have fallen for that. However, that's business specific. Sometimes in some instances, we would prefer to use GAAP net income over cash flows. It really just depends on what's really going on. And those are those accounting discrepancies and why you really have to pay attention to the business in question and not just paint in broad brushstrokes. Okay. So, that's again, investing is heavily nuanced and it really depends on many, many different factors. So with this business in particular, net profit margin was a little bit misleading versus actually taking a look at the cash flows. And then that would have actually, indicated a different story. Because you can also see here, ROE was terrible back then. And you would have been like, oh, that's disgusting. It's terrible. What a terrible business. 6% ROA, 8% ROE. Disgusting. Get out of here. But you would have missed out because, you weren't looking at the cash flows. All right. Excellent right here. Look at that. Look at those earnings quality, always above 1. What can you expect from Google? And then book value per share going up, that's just showing us that they're increasing the value of the business on a book value basis. So, it's good to see. All right, let's go to the, well, I'm going to take a little bit of a quick break here to kind of address some of the concerns, like political concerns. And that has to do with basically all the risks that really, not prevails, but clouds over Google, right? It's the political risk. So they operate on many different jurisdictions across the globe, and they have to deal with many different governments, and then they have to placate to those local governments. And so that adds always some nuance, or not nuance, but some volatility to the share price here and there. And those have generally always been buying opportunities because none of those jurisdictions really can stop what this is. This business is something, that's it's something else. It's very unique, but there will be always new opportunities like this in the future. Just because you missed this one or you feel like you missed this one doesn't mean there will be another one, right? This is actually maybe a good case study. And now we're going to explore together on my thought process, whether or not I might actually sell Google. I'm just going to hold it, but I'm more incentivized not to sell because I don't want to pay that tax bill. I really don't want to pay that tax bill, even though the grand majority of it, I think the grand majority. Do I have any some with short-term? I think I might have a couple. Or a couple tranches that I bought with short-term capital gains, but no, definitely. Yeah, definitely I do. But I might strategically sell those shares differently. All right, so let's actually go back to the model and let's discuss the valuations. So I have right here plugged in 10%. And again, remember what the analysts say over here, but I have right here 10% discount rate, assuming a 1% buyback, which I do think they're going to continue to do the buyback, and a little discussion on the buybacks. So generally, I don't like to see when businesses are wasting their money on buybacks, but from Google's perspective, they're not really wasting it in the same sense that other businesses would, because when I mean waste, I mean they're not investing it back into the business, they're just squandering it. So Google makes so much cash, they literally have no idea what to do with it. I think I kind of showed you guys that with the ratios, right? It's quite obvious that based on the ratios, they literally have so much cash, they literally do not know what to do with it. So if a savings account yields less than 1%, and most bonds don't really yield that much, why not just buy back your shares that has a yield, around at least 4%. If you think of it from the PE ratio perspective, yeah, it's around there. And ignore the price to free cash flow, because this has now been adjusted for the shares. And so basically it's been cut by about, the cash flows are being reduced by about the size of the shares that are represented here. So that everything is calculated correctly. And then that equates to about 45%. So everything is now adjusted, so we should get an accurate representation of the business. So assuming an average rate of return for the market, if we grow up 5%, you'd have to buy this at $1,646, so about 50% down from where it is today. All right, so let's take a look at what happens if they achieve closer to average growth rates. So if we see a 10% growth rate, we're getting there. 12%, we're almost there. And then a 15%. So at a 15% growth rate, you can see that at a 10% required rate of return, it's currently at a buy, even though with the rise to about $3,000. Let's actually see if it's 13 is a good. So 13 is almost there, because now it's 3,000. Let's see, 14. 14 should be good too. All right, so let's take a look here. 10%. So let's actually change that to 12%. So at 12%, we do probably have to grow at a faster pace. About 20% is, well, that's a little high actually. 17%. So at 17%, we're pretty much almost there. So what I'm trying to get at is Google's actually kind of pricey based on the cash flows. Okay. So it's not the same deal it was, but it's not a terrible deal either. Now it's just based on the uncertainty that it may or may not actually achieve those growth rates. And that's the one concern, at least for me. So will it get there? I don't really know, but I'm heavily contemplating actually maybe taking my profits on this one, but I'm leaning more on just holding and letting it compound further and seeing what happens, right? I don't really know where I'd deploy this cash if I just came across it. So I'm waiting for other opportunities, and I am not, it's not like I'm cash poor right now. I have plenty of cash in the portfolio. I'm actually just waiting for opportunities to come by, waiting for the market to give them to me. And I'm in no rush. It's not market timing. It's just I'm just looking and hunting. And when I find something, I'll pounce. I'll say this. I think Facebook is a little more interesting than Google at the present moment, right? And I've already discussed that in that last video, but Facebook's already back on the up and up. So unfortunately, maybe it won't be forever. Maybe I take my profits in Google and I shove them into Facebook, right? So actually, and I think, well, I'm trying to think right now the details, but I am sure that a big portion of the Google position is in my retirement accounts. So it shouldn't be actually too much of a tax bill. Should I do it now? I just don't want to then, tax planning, guys. Oh, all right. That's for another video. On that note, guys, you guys have any questions, comment down below. I actually enjoyed talking about a long time holding of mine. And, maybe changes. There's plenty of positions that are no longer in the portfolio. And I've little nibbles here and there, told you guys about it, but I'll let you guys know what else is in the portfolio soon. I think the next video is Baba and maybe Tencent after that. But I'll be talking about Alibaba and the point of why it's in the portfolio, and some of the maybe opinions you've never heard before, but for those of you who have been following the channel for quite some time, know exactly what those opinions are. On that note, guys, I hope you guys have a great one. I'll see you guys on the next one. Bye.